Welcome to the weekly update, where I'll go over the action in the market for the week of May 30th through June 2nd, and then we'll see how things look for the week of June 5th through the 9th. We had a pretty up week overall. It was kind of a U-shape when we look at the intraday chart. We had a strong finish after kind of having a little bit of trouble earlier in the week. The market seems to be switching back to more positive on the daily charts. We're also seeing a lot of that carrying through on the weekly charts. Some of our short-term indicators are starting to look extreme positive, and we're seeing a few of those in the weekly charts as well. But since we were able to get above 4,200, that has really shifted the market a lot more positive. Now, the idea is, can we stay at this level? We do have some previous highs that we hit back in August. Can we get above that, or will that provide overhead resistance? Before I get started, please know that there is a PDF of all the slides and charts that I use in this video. You can click on the link in the description below. I do have a private Facebook group that you're welcome to join, and there is a poll that I will be posting after I get done with this video. Please also know that if you can't find me on YouTube for whatever reason, go over to Rumble. I do have a channel there. Here is the link to that channel. You never know what can happen with YouTube. They might take your channel down for whatever reason, and I don't have the ability to be able to communicate with you, so I also post on Rumble. All right, let's go back and talk about the week session. For the week, the S&P was up 1.83% on above average volume. We're going up and we're seeing volume start to get greater, so that is a good sign. The technicals are still pretty positive overall on the daily charts as well as the weekly charts. I have the debt ceiling listed here. That's pretty much done now. They did reach some kind of a deal. Just what that deal was, we won't really go into that. The market is mainly happy that some kind of a deal had been reached. Inflation and interest rates are still the real concern of the market. We're coming near the end of earnings season as well. Our trend is getting a little bit stronger. When we get to that chart, we show the ADX starting to go above the moving average, and it's starting to turn up, and the green line is on top, so it is positive. And we're seeing a very similar thing on the daily charts. Here is the breakdown for the week, where the Dow was up 2%, the NASDAQ up 2%, the S&P up 1.8%. Small caps, which had really been falling behind, they had a good week. They were up 3.3%. So for the week, just to go over some events that happened, the stock market did have a strong showing for the week. The S&P approached 4,300 on Friday. We ended up getting at 4,290 for the high in Friday's session. A lot of the uncertainty about the debt ceiling was finally eased after they did pass a deal in both chambers of Congress. Now it's flying off to the president to be signed. We did get some Fed speak this last week, and that caused a bit of confusion because there was some conflicting information. First of all, Cleveland Fed President Mester, who's not a voter, said that she sees no compelling reason to pause rate hikes in June. Okay, it's a good thing she's not a voter. Governor Jefferson, who is a voter, said that he thinks that skipping a rate hike at the coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. That's more dovish. And then Philadelphia Fed President Harker, who is a voter, said he thinks that the Fed can take a bit of a skip for a meeting. That's more dovish. Richmond Fed President Barkin, who's not a voter, said that he has one of the higher rate forecasts on the committee and he hasn't backed off of that. Again, probably a good thing that he's not a voter. And then interest rates were down on the week and the dollar was also down, even though it is trying to rebound, and I'll show you that chart. So on Tuesday, there was news that over the weekend, the debt ceiling deal had come through. It suggested that stocks would move higher, and it looked like that we were going to just shoot up. But then once we opened, we ended up going down a lot on that day. Then on Wednesday, there was still uncertainty about the debt ceiling deal, and that was really putting a cloud over the market. The major indices spent most of the day trading in a very narrow range. Then on Thursday, this is when things started to shift more positive. We did have a negative open on Thursday, but then we just shot up out of that and we ended up closing above 4,200. Then on Friday, this was when the real strength came. The market closed out the week on a very strong note. The debt ceiling deal had been announced that it was passed. The employment situation report was also taken as positive. Now, let's go through and look at our poll results. I had 7 questions this week. The first one, if or when the debt ceiling agreement passes, do you think the market will go higher or lower? A little over half thought we would go higher. They ended up being correct. Lower, a little bit under half. Then down here at the next Fed meeting on June 14th, do you think that the Fed will raise rates, keep rates the same, or lower rates? Nobody thinks they'll lower them. 67% think that the rates will be raised. Over on the right-hand side, do you think the U.S. will enter a recession? 60% say yes in 2023. No, that there will be a soft landing, 20%. And that we will go into a recession, but it will be in 2024. That's also 20%. Then concerning the banking crisis, everybody believes that there's more to come with that. Then the other questions, for the week that will end on June 9th, which is a week from the time I'm recording this, do you think the S&P will be higher, 50%, lower, 50%? Can't split that any different. Do you think the recent potential debt ceiling agreement will be approved? Well, 78% said yes. For the week that just ended, do you think we'll be higher or lower? 40% said higher, 60% said lower. Let's go through some Isabel Net charts. The first chart is the insider transaction ratio. These are legal insider transactions. There's legal kind and there's illegal kind. And they track the legal kind because if you meet the qualifications for being an insider, you have to report when you're buying and selling. We're starting to go back up a little bit. We're not really at an extreme reading right now to give us a bearish indication. The next chart just shows the biggest monthly inflow going back to February of 2021. We're seeing a lot of money flying into tech. Now, some of this is chasing returns that have already happened, and this will probably continue to go up. That's just a guess. Because people see, oh my gosh, semiconductors, oh my gosh, NVIDIA is going crazy. And then they jump in enough to see a little bit of a profit, and then things kind of turn and go back the other way. That's what often happens. Then looking at the U.S. share buyback authorization announcements, they're down 14% so far in 2023. If we start to go up, you'll probably see this number go up more positive. Then looking at the Magnificent Seven, Edward Yardeni has the Great Eight, and just how they're doing right now and how they've just been climbing to the moon, it would seem like. And then comparing that to the yield of the 10-year Treasury. Then just to give you an idea, these are the list of seven right here. Microsoft, Apple, Google, NVIDIA, Amazon, Meta, and Tesla. The ones that you hear about pretty much all the time. Then looking at the all employees and temporary help services, this came down below this red line, but now we're seeing some improvement here. Will this suggest that the employment situation will still stay strong and possibly prevent us from going into a recession? Then looking at the dash to cash, where a lot of money is going into money market funds, not so much because then it's going to come into the stock market, but because they're getting next to nothing in their savings account at their banks, so they put it into a money market, which is giving a lot higher yield. Looking again at tech stocks against small caps, where tech stocks have really been outperforming, we're starting to go back above the high that was set way back in the year 2000. This was when the dot-com bubble happened. Now we're starting to see AI as the latest and greatest next thing, and this is pumping up a lot of the tech stocks. FactSet had some interesting things on their blog post. It says analysts making smaller cuts than average in their earnings per share estimates for the S&P 500 companies for the second quarter. Here's a chart showing that, yeah, they're down, but they're down 2% where they had been cutting it a lot more. Then we have another chart here showing that the price is starting to come down, and then comparing this with the earnings per share forecasts. And then this just shows you how optimistic these folks can be. The bottom line here is 2023 forecast, and then we're looking out to 2024 forecast, and this is on top of the other line, so this is greater. Looking at our charts, here's the intraday chart going back to Tuesday, where you see at the beginning of Tuesday, we kind of swooped down, did a big U shape, and then took off. Looks kind of like a coffee cup or something there. But in Tuesday's session, we did pretty much chop lower. We gapped lower on Wednesday, never really recovered all that much. Thursday is when we started to see the real shift. We had a lower open, and then we just shot right up. On Friday, we gapped higher, didn't give too much of that back, and then really shot up going into the close. So for the week, the small caps actually did the best, and they're the ones that have been really giving us some concern right now. It would really help the overall market if the small caps could stay strong, followed by the mid caps, which also have been having a lot of weakness. In the daily videos, I discussed this at length. When you look at the small cap growth versus small cap value, we're seeing a lot of strength in there. And if you're more interested in that, please tune into the daily videos. The NYSE was also positive, as was the Dow, the S&P, all the indexes ended up being up on the week. Then going back to the beginning of the year, where we have the NASDAQ 100, the NASDAQ and the S&P performing the best, but now all of the indexes have gone back into positive territory. But then going back to the all-time high, they're still underwater. The NASDAQ and the small caps, especially the NASDAQ, it fell the most. You can see over here, the NASDAQ's actually paring a lot of its losses, but we're still underwater across the board. Looking at our different sectors, they were all up on the week, with discretionary actually doing the best, and that would also help the growth side of things. Real estate, which has been getting hammered, it was up pretty good. Materials, industrials. Down at the bottom, you see where staples, they were just barely up in utilities. Tech did have a good week, but it didn't end up being as strong as some of the other sectors. Then we look at our relative rotation graph. So the first quadrant would be a plus X, plus Y. Then we have a negative X and a plus Y, because we're above the middle line here. Then we drop over to the lower right-hand corner. That would be a plus X and a minus Y. And then where we get a minus is in this area in the lower left. The strong areas have been communication and tech, and they're really holding on to their own. A lot of these other areas have shown a lot of weakness, but you can see where these red lines are starting to turn up. That's showing some improvement. If we really want this market to go higher, we're going to need all the sectors to come in and really participate. Then looking at the sectors for the week, where we had materials, healthcare, industrials, real estate doing pretty well. Discretionary was pretty much in the middle. Negative, we had communications, staples, utilities, and tech. Now this just measures the 4 trading days of the week. Going back to the beginning of the year, tech, communication, and discretionary are doing the best. All of the other sectors continue to be underwater. Then going back to the all-time high, energy is still doing quite well, and all the other sectors are still negative. Looking at sentiment, we're not getting extreme right now with our positive reading. We're at 65. Here's the historical chart. If we shoot up above 75, that's when we get extreme. Then looking at the latest reading of the active asset managers, they're pretty much neutral now. It actually fell a little bit. And then looking at the VIX, where it's just been falling, both on the line chart and on the bar chart. The right X bear bull ratio is pretty much at the midpoint, not giving us an extreme reading. This is also positive. When this line is going down, that means tech is outperforming cash. Where in 2022, cash had been outperforming tech. You can just stick it in your pocket and keep it there. Now this ratio is starting to go back down. That's more positive for the tech sector. Then looking at the latest reading of American Association of Individual Investors, they had been extremely pessimistic. Now they're starting to show some improvement. With this past week doing better, this is probably going to go up. The Ulster Index continues to show that there's not a lot of fear in the market. Looking at the economy, here are the GDP now estimates, where we're right at about 2% for GDP. When you take the top 10 and bottom 10 forecasts, we're looking anywhere from 2% down to about a negative 0.5%. Here's how it looks on a bar chart, where we're just about at the 2% for the second quarter. Looking at our spread between risky and not as risky bonds, we're not really spiking up yet. This is actually falling back down. Looking at the financial conditions index, we're still below this black line. When we go above it, that's when we get concerned. The tightening standards that we show on this chart, it hasn't been updated since the last time I did this video, but they're really going up overall, and that could really put a drain on the economy if people can't borrow money from banks. Then looking at the real-time SOM recession indicator, it was updated on Friday. We're still below this black line. When we go above the red line, that's when we get concerned. And then looking at the smooth recession probabilities, we're also at this black line. If we go above the red line, that's when we're concerned. The Brave Butters Kelly Index was updated this past week. We're going above this black line. That's a little bit of a concern. When this really starts to go up, that means there's more of a chance that we could head into a recession. Looking at inflation, this is the nowcast that you can look at every day. We're pretty much flat when we look at the core CPI and the core PCE inflation. Where we're seeing it really drop is in the headline number between the CPI and the PCE. FedWatch, this is kind of interesting. As of the close on Friday, May 19th, there was an 82.6% chance that the Fed was going to keep rates the same. Then we go again to the next Friday, May 26th. That had dropped to 35.8%. After this Friday, we've gone back up to 74.7%. Then looking at this in a little different way, the blue line is where the Fed probability is at right now. Then we look at the bar right next to this. This was the previous day and what the probability was. The probabilities were a lot higher, but if we go back a month, we were back up to this same basic range. Looking at the Fed balance sheet, it's continuing to drop as the Fed is dropping things off of their balance sheet. And then looking at the total assets and how they're declining, this spike up was during the banking crisis, and now it's starting to go back down. Looking at breadth, this is a little concerning. We're seeing based on price, we're still right down at the moving average. That might be a little hard to see, but we're showing some improvement. We turned up this past week based on price. The new highs, new lows, this is also a problem on the daily charts. We're not really breaking out with the new highs. Even though we broke above 4,200, we're still declining with our 4 period, and we're pretty much flat to declining with the 10 period. But accumulation distribution, we're above an advancing moving average. That's positive. We're starting to get a little extreme with our shorter term moving average. That's the blue line, but we are positive overall. Looking at our trend, this is where I say that the ADX is starting to go back above its moving average. Now we're still below 20, but if you're more aggressive, the green line's on top, so you could default to the positive. The mass index is getting far away from these lines, so it's not generating a signal. The Erin is looking pretty good. The oscillator is above 0 and advancing, so that is positive. And we're seeing a very similar reading on the daily chart. Looking at some of our charts for the S&P, we're starting to break out above resistance on the daily chart. And you can see at the bottom, we had a huge volume increase earlier in the week, but we're still above average overall. We're starting to stay above this midpoint of the trend channel, so that's more positive. And we're above the monthly pivot point for the S&P. That's also positive. We're above the 50-period moving average. Our long-term trend is still positive. The McClellan oscillator crossed back above 0 and is looking more positive. The summation index, though, is still below 0 based on price, and we're turning back up based on volume. The Swenlin trading oscillator crossing back above 0 based on price and going more above 0 based on volume. The PMO is still looking positive, but we're dropping below 0 with price, and we're coming back up based on volume. And we're seeing this discrepancy between price and volume on some of our daily charts as well. Looking at our PMO study, we're starting to almost get a little extreme with the PMOs that are rising, but that is showing a lot of improvement. The buy signals have turned back up, but we're still declining with the PMOs that are above 0. Part of this can be explained that we're just seeing a few stocks leading the overall market. Those PMOs that are above 0 just isn't getting any stronger. That had changed for Friday's session. Now we'll have to see if that continues going forward. The BPI is still below 50 and advancing, seeing the same thing on the daily chart. The percent B, which measures how far are we either above or below one of the Bollinger Bands, we're starting to get extreme. We're also showing an extreme reading on the daily chart. Then looking at all the oscillators, we're turning back up with the slope. We're still looking good with the TSI. The MACD is positive. The PMO is positive. All the other oscillators continue to be positive. We're turning more positive on the daily chart, but our longer term oscillators are pretty much flat. Then looking at the Chaikin money flow, this is still hanging in there and looking strong. The Chaikin oscillator starting to get extreme positive, but that is still positive nonetheless. The force index above 0 and advancing, that's positive. The money flow, it was flat, but it's above 50. Rate of change going back 1 week, that's positive since we had the up week. This is another little concern. When we go back 50 weeks, we're starting to get kind of an extreme reading. Now, we could still go a lot higher than this, but this is an area that sometimes suggests that we've gone up a little too far too fast. The RSI is above 50 and advancing. That is positive. The special K, though, that's much longer term. It's still looking like it might drop below the red line. That could be longer term negative. The Stochk RSI is still extreme positive. The Williams percent are also extreme positive. The ultimate oscillator into extreme positive territory. The Vortex has the green line on top and going up. That's positive. And on this longer term fib chart, the chart is just looking a lot more improved. The Copic curve is turning back up. That is positive. Our different charts. The Heiken Ashi is still positive. The Kegi, black line pointing up, that's positive. The Renko has open blocks, that's positive. And the 3-line break is also positive. the ease of movement. And the reason I include this is I chart this a little different way. This is an equi-volume chart where it tries to take volume and price together. Red is negative, green is positive. Then we look at the ease of movement. We were up because that was an up week going back 1 week. Going back 14 weeks, we are showing some improvement. There was a new X drawn after Friday's session on the point and figure weekly chart, and we're still working off of an ascending triple top breakout that was generated on May 15th. So this chart's looking more positive. Our different trading systems. The Elder Impulse system for the S&P weekly chart is positive. The dots are still underneath with the parabolic SAR. That's positive. And then looking at the broad market, here's the S&P on top. We're still seeing mid caps kind of pretty much going sideways, but they did have a good end to the week. Small caps also going sideways and are also underperforming the S&P. The Dow remains in an uptrend. The Nasdaq is really in an uptrend. The Nasdaq 100 is really in an uptrend. The mid caps, they're almost getting to a death cross here. We've already had a death cross on the daily charts. But again, when you look inside the mid caps, growth is really doing quite well when compared to value. The small caps, kind of the same thing. We've already had a death cross on both the daily and weekly charts, but we're seeing internal strength when you compare growth with value. The NYSE also going down overall, but is still in an uptrend. The Wilshire continues to be in an overall uptrend. All stocks are in a nice solid uptrend. The biggest software companies also in an uptrend. The FANG index is really doing well. If we continue to go up, we might hit some resistance at this previous high at about 8,000. However, ARK is still negative overall, even though it showed some improvement this past week. Looking at the bank index, where it's really falling overall, but the RSI is starting to come back up after being extreme negative. The MACD is still negative, but it is trying to turn positive. Looking at the deposits, they continue to fall off, but we saw a little bit of an uptick in the latest reading. Some broad market things that we look at. This is traditional Dow theory. It's more pronounced on the daily charts, but we're seeing how transports have really been underperforming the Dow, and utilities shorter term have really been underperforming both of the other indexes. And so that's a bit of a long-term negative. The CRB index continues to be in a downtrend. Oil continues to chop around the 70 level. Copper, still in an overall uptrend, but falling back and could be getting ready for a death cross soon. Gold continues to be in an uptrend, even though it fell back. Silver also in an overall uptrend, but recent weakness. Here's the dollar, where it tried to go back up, but ticked down just slightly this past week. Looking at bonds and interest rates, the total bond ETF continues to be in an uptrend, but stocks continue to really outperform bonds when we look at the monthly chart. Then this is the MOVE index, which measures bond volatility. Since bonds were up, this fell. Since stocks were up, the VIX fell. Down here, the green line is the spread between the two, and then the red line is the S&P. Please be aware that this is a daily chart. Then looking at a daily chart of the yields, where we're going back up the last few days. Then internationally, looking at the US, UK, and Germany, they are starting to come down on the weekly basis. Japan is its own little story that we're keeping an eye on. That's the red line that's really low. Then looking at the 1 month yield and subtracting the 3 month yield, we're back more to a normal reading. Relative studies. This is a new look at what we've been watching for quite a while. This is the intermarket analysis chart. Instead of going back to the all-time high, I go year to date now, where in first place is the S&P. That's the black line, followed by gold, and then the blue line are bonds. The green line is the dollar, and the red line down here is oil. Now, if you go back another year, we still have oil in the lead, followed by the dollar, then gold, with stocks and bonds continuing to be negative. The NASDAQ 100 is really outperforming the S&P 500, and the S&P 100 is really outperforming the S&P 500. Gold still in an overall uptrend compared to the S&P, but we're showing some weakness. Bonds continue to underperform stocks on this chart. And growth to value. Growth is still in an overall downtrend, but it's starting to break above these moving averages, and we might get a golden cross soon. Gold to the US dollar. We came right up to this trend line, and we bounced back down. Low volatility stocks, which really did well in 2022, are now starting to show a lot of weakness. Energy, which really did well in 2022, we see a recent death cross when compared to tech, and it's starting to underperform. Discretionary, also in an overall downtrend, starting to come back up when we compare it to the staples sector. Looking at our secular and cyclical trend studies, this is the NYSE breadth thrust. This was a signal that was triggered back in October, and we're bouncing up out of that. Similar to that is a ZWAG NYSE breadth thrust, where it also generated a signal back in March and then shot up here to give the confirming signal. This is still on the books indefinitely. Then here's another one that I showed last time. It's the Zahorchak method, which I jokingly say is a good, solid Midwestern family name. But basically the takeaway from this is for 2022 and 2023, we were negative. Things shifted in the market, and now this is giving us a positive reading. Looking at our momentum studies, if we go back to 1998 to 2004, we broke out above the trend line 2 times only to have it fail. The reason we can look at is that the MACD was weak both times. We saw the same thing in 2007 through 2010, broke above the trend line, but the MACD was flat. So we compare that to what's happening now. We did break above the trend line, but the MACD so far is above 0 and advancing, so this suggests more strength. So what's the outlook for the upcoming week? What I've done here is just post the economic calendar. Tuesday, we don't have any economic reports, and Friday, we won't either. Then looking at the Stock Traders Almanac statistics for just June 5th. Now, first of all, I talk about the whole month of June. It says the summer rally is the weakest rally of all 4 seasons. It's up 9.4%. The winter is up 13%, spring 11.8%, fall 11%. Another thing to be aware of, as we get more to the end of the quarter, which would be the end of June, there might be some portfolio pumping to try to make their records look a little bit better. And during a pre-election year, the month of June is typically up 1.5%. Now, just focusing on June 5th, the Dow is more negative, being up 42.9% of the time. The S&P is still neutral to negative, being up 47.6% of the time, where the NASDAQ is a little more neutral to positive since it's over 50 at 52.4. We tend to be a little bit more positive than negative for the month of June, going back the last 72 years. There's a chart put out by Jeffrey Hirsch, just showing that we will be on the 3rd trading day of the month on Monday. There's a tweet up here that might be kind of hard to read, but what we tend to see here is initial strength in June, then a bit of a pullback, then we see some more strength, and then a little bit stronger pullback, and then a good end to the month overall. That's what his research is telling us based on the Stock Traders Almanac. Also, looking at another Stock Traders Almanac chart, this is annotated by Dan Byrd. I have a link to subscribe to his email that's totally free that you can get. For the NASDAQ, the best 8 months go into mid-July. We're also looking a little more positive overall. There's this idea, sell in May and go away. Well, when it comes to the NASDAQ, you might want to wait until the middle part of July to sell. Then we have this as a potential warning sign going back to 2011. Here's what the S&P was doing with the blue line. The black line is what it did back in 2011, where we saw some weakness, a bit of a recovery. Then in late July and early August, that's when we saw a real downturn. We're wondering if things are going to play out that way this time. Cyclical Capital also has that same chart, pretty much saying the same thing. Looking at the upcoming week for any scheduled speeches by Fed members, there are none scheduled. So our scenarios. This is just based on Monday now. We can't really go with the down one because the technicals are switching over to positive. There have been a lot of numerous negatives and negative divergences, but they're showing some improvement. Now we're waiting to see if there's some follow-through to this. It's hard to go with the up one as well because we're just not trending. The same thing can be true on the weekly chart. Even though the ADX is turning back up, it's still below 20 overall. Where on the daily chart, the ADX is also getting stronger since it's above its moving average, but both of them are still below 20. It's positive because the green line's on top and advancing. I've also started to talk about a shorter term ADX for measuring the trend. It is starting to trend positive, and we'll keep an eye on that to see if that bleeds over into the longer term chart that we use. Warning signs. Based on Friday's session, the skew index, which I don't talk about in this video, It's a variation of the VIX, where the VIX looks at the money options, the skew index looks at out of the money options, and we're getting a pretty extreme reading on that chart now. The thing is, sometimes that suggests the market's going to go higher, other times it's marked a top, so we're not really sure if this is positive or negative. The new highs, new lows for the S&P 500 are not expanding even after the strong day on Friday. The bullish percent indexes are diverging. They're not really participating in this upward move. There are a lot of negative divergences and a lot of signs of weakness that could be negative overall. The VIX is still showing a lot of complacency on both the daily and weekly charts. The cumulative new highs and new lows on the NASDAQ, they just continue to go down as the NASDAQ's been going higher. The 3-month yield, it's at levels that we saw just before the great financial crisis. So we're wondering, is that flashing a warning signal? The small caps and mid caps are underperforming unless you look inside and see that growth is outperforming value. Then we still have some earnings season issues to deal with. On the positive side, there is positive seasonality and some setups that apply to the whole year. The Copic curve and the Pring bottom fisher are generating buy signals. The S&P closed above a downward sloping trend line that we've been following on the daily charts. That initially acted as overhead resistance. We came back down from it. Now we've been able to close back above it. We've switched from being risk off to risk on, which favors stocks. Lower price levels may provide support if we start to fall. The S&P is outperforming utilities, which often gives support to the S&P. The NASDAQ and NASDAQ 100 continue to just go to the moon. The staple sector is declining when compared to the S&P 500. Taken another way, the S&P 500 is outperforming the staples. This could also give some support to the S&P. And small and mid-cap growth is showing strength when compared to small and mid-cap value. And then will this resolution lead to a follow-through rally? We saw that kind of on Friday. Are they going to start to sell things in the upcoming week? We don't really know yet. So thank you. I hope you found this helpful. Please feel free to check out the daily video and the other videos that I post over the weekend. So I do hope that you have a very nice weekend, and I will talk to you in the next video.